In this video, I'm going to share with you the highlights from the best videos with the smartest people in the silver game. We're going to have a look at where the price of silver is likely to go, and could this be our last opportunity to buy silver at these prices?
With all the buzz about the silver squeeze, there's a lot of chatter now about whether it is real or fake. Do the hedge funds want you to go long, so they'll keep lining their pockets? We're going to be speaking about this with my guest today, Willem Middelkoop. He is the author of The Big Reset, Gold Wars and the Financial Endgame. He's also the founder of the Commodity Discovery Fund, and he joins me now on stansberryinvestor.com. Willem, it's been a long time I've wanted to speak with you, so welcome to my show here at Stansberry Investor.
Thanks for the invitation. Great to be here, finally.
Yeah, well, we have a lot of ground to cover today. I know you've covered gold in your former life as a journalist, but it's interesting that your book, The Big Reset, you wrote this 5 years ago, yet it's having another moment.
7, 8 years ago. I wrote it in 2013.
Okay, but it's having a revival, right? I saw your talk with Max Kaiser where he said you are the Oracle of Amsterdam because a lot of what you spoke about has come to fruition. So I want to talk about that with you, about this moment that your book is having, that gold and silver are having. So let's start with silver, since that's dominating the news these days, and the silver squeeze. We saw what it did to the price, what the people did to the price. A lot of precious metals investors were celebrating, saying, finally, this is exposing the ugly underbelly of Wall Street. While there's another camp that's saying, hey, the silver squeeze is not real. Don't go long silver because you're just going to be putting more money in the pockets of these hedge funds. So how do you see it, Willem?
There's one great example which actually tells you how this will play out, and that's Palladium. Palladium is a very small market, just like silver. Palladium was managed, manipulated for years, just like silver, just like gold, just like platinum. If you look at the concentrated short positions, Palladium was among the largest position relative to the size of the market for years. Then the physical demand became so large that it overwhelmed the paper shorts. This happened in 2017, 2018. The paper shorts, they had to deliver physical palladium, and they couldn't do that for that price. So palladium went through the roof. The palladium price went up fourfold, and the palladium shorts decreased their position until they were, well, relatively normal. If you look to the situation nowadays, still concentrated short position in silver and in gold, especially in silver, and the physical demand will overwhelm them now. That's the big risk. And that's why there's an emergency meeting called by Janet Yellen, and the CFTC is joining that meeting because I think they have a big problem on their hand, and they've been able to manage this market for decades. And I'm afraid that the palladium scenario will now be unfolding. And that's very, very risky for the financial system as a whole, because palladium doesn't play a role in the financial system. And silver isn't not playing a role in the financial system, but if silver breaks, then the gold manipulation might break as well. And then you have a real crisis within the international monetary system, because then the dollar system is at risk. And that's what my book is all about.
Okay, so that's really interesting, because we were hearing about the supply constraints with palladium and platinum back in February in South Africa, obviously the largest producer of these two metals. What happens to the price then of palladium, Willem?
Well, the price of palladium went up 4x between 2017 and 2020, and this was due to the fact that in the car industry there was a shift from combustion engine vehicles towards the hybrids, and in the hybrids you need palladium for the exhaust system. And this is all a little technical, but it resulted in a huge shift in the market, that there was more platinum needed than was more palladium needed in the exhaust systems than platinum, and that caused a squeeze in the market, a physical squeeze, and that's why the shorters, they really had a problem. This was all 3 years ago, so before Corona. But this is a great example. It's a great playbook for what can happen to silver, and I think what will happen to silver, because central banks can solve each and every crisis, but they can't print silver like they couldn't print palladium.
Yeah.
So you can't solve this problem.
And that's correct. The supply for silver is just not there. Now, there was talk that it was just supply issues for small bars and coins and stuff like that. However, I'm hearing reports that 1,000-ounce bars for commercial purposes are hard to get as well. Basically, you've got to wait in line to get 1,000-ounce silver bars. So the supply of silver, there is a squeeze happening. So, we need to continue holding on to our silver and continue to buy more and request more of that physical silver.
Now, we also happen to think that while gold does this, gold's the mama of the monetary metals. Silver's the baby. Gold miners are somewhat, the wild children of the gold market too. They oscillate violently, but we think that silver is now poised, because of our technical analysis of its relationship to gold on a ratio basis, a spread basis. In July, when silver broke out on our annual momentum, so did its spread versus gold, meaning it shifted from underperformer to outperformer. And I think that will continue during the rest of this monetary bull market. I have an expectation that the way things look on macro technicals of many markets, foreign exchange, commodity situation, the pending stock market vulnerability, we'll get into that in a minute, that this bull market in gold is likely to come and go much more quickly than some of the prior ones. In other words, rather than incremental, which a lot of people are used to incremental trends, once you get going, you go at the same angle and all that stuff, that we could go chaos theory and go into a very rapid upside, so that we could get to maybe that 8,000 gold by late this year, early next year. Would not surprise us at all. So where would that leave silver? Well, in our opinion, you could see silver over $200 an ounce. So if gold goes up another, 4 or 5-fold from where it is now, or 8-fold from its low, we think silver could easily go 10-fold from where it is now in the high 20s.
And is that on the same timeline?
Same timeline. Silver will move with gold. The issue is the percentage gain. While gold's making 10%, silver makes 20 or 30, And you see that often day-to-day action even, over since the end of last year to the high we made today in these markets. Gold went up, a nice good single-digit percent, but silver went up almost, $1.50, on a percent basis, much more than gold. And we think that ratio will continue, and that silver will be a better place to be than gold on a percentage basis over the next year or so. And they're leaders. They went out front well before the commodity, quote, inflation even began.
In 1971, this bought you 57 ounces of silver. Today, it buys you around 3. The question is, though, with the tsunami of liquidity being pumped into the economy, and my argument for governments and central banks to continue to create new currency units, UBI, you name it, all sorts of programs just to continue to throw currency units out there into the economy and into households' back pockets. The question is, how long will it be before you need several of these just to buy a single ounce?
So let me ask you this, Ted. If there is funny business in the silver industry and blatant manipulation happening, why would an investor invest in silver then if the price will not be allowed to go higher?
I heard you ask that question several months, I think, back.
I asked Keith Neumeyer, yes.
Okay. Yeah. And I was like, I happened to listen to it. I wanted to reach through the computer screen, okay, and interject, okay.
And here's your moment.
It's a great question, okay.
Thank you.
The answer is this. The answer is there's 2 kinds of manipulation. There's an upside manipulation and there's a downside manipulation. we're all familiar with upside manipulations. The Hunt brothers, coincidentally, manipulated silver up to $50 back in 1980. And there's been other instances of manipulation to the upside in the copper market by the Sumitomo trader that we referred to as Mr. 5% or whatever. When a market is manipulated up and the price is high, that's the last thing that you'll want to do is buy it, because a manipulation is an artificial price. So an upside manipulation creates an artificially high price, and that's the last thing you want to buy. A downside manipulation, on the other hand, which we have in force in silver, is exactly the opposite, that the price is artificially low. So that becomes the very best reason to buy silver, is because it's artificially manipulated to the downside. And we know from history that manipulations have to end someday. And one day when they do end, okay, they end abruptly and violently. And if it's an upside manipulation, then the price falls out of bed. If it's a downside manipulation like we have in COMEX silver, then the price will truly explode. You couldn't find a better reason to buy silver than because it's manipulated.
Very well said, Ted. Let's wrap with this, because, you know, in past interviews, I've brought up triple-digit silver. Where do you see, okay, with all this enthusiasm in the silver market now, people paying more attention to silver, have you changed your forecast? Where do you see it headed now?
I haven't changed my forecast. I see it headed to the heavens. I mean, you know, people want to put numbers on it to make them, I don't know, make them feel better or something like that. I'm not so much looking at the number. It's going to be a very high number, you know, times factors of what we are today. Okay, that's easy enough to say. But what will be the key to look at to judge how high it might get is this concentrated short position's got to fall by the wayside. These shorts have to be carried out on a stretcher and just thoroughly disgraced and destroyed, which is going to happen. Okay, and then we have to see how things always overshoot. We don't know how high prices can go in a blow off, so I'm hesitant to throw a number out because it sounds crazy, but there's enough people out there saying 50, 100, 200 that what difference does it make? It's going to go substantially higher than it is today, and I don't see it going substantially lower since it's already manipulated and priced artificially too low. So why spend a lot of time trying to figure out what the exact number? We're not going to be able to guess it. It's whatever. It's going to be much, much higher than it is now. The best thing you could do is to hold as much, own as much as you can. I wouldn't do it on margin. That's always dangerous. But I'd buy it if you know, and hold it, and not be so concerned with how high it might go or when it might go. I always think it's any moment, but that's hard to quantify.
So Hos94, who's a deflationist, has got a silver price target of $230 to $257 before the end of this decade that we're currently in, and he does say that the silver will be the best inflation trade. However, he just says that there's going to be deflation first. And Henrik Zeberg from the Zeberg report is in the same camp. He's saying that we're going to have deflation. You can see this is his chart. You can see down the bottom there that he says we're going into deflation first before a very, very large stagflation environment. So my argument against the deflationists is they all say, just about all of them, every single one of them except for one or two that I know of, all believe that the end game is a stagflationary environment. However, my attitude is, why don't you just invest and prepare for that end game scenario? Why try to get tricky and trade based on, you know, what the government and central banks will or won't do? If we all agree what the end game is, why don't we prepare for that? And you know what? If there is a pullback in silver, if there is a deflation, if there is a liquidity event because the stock market crashes and margin debts are called in and everyone's trying to just liquidate all sorts of assets, then yep, gold and silver will have a pull down like they did back in March last year. But if that happens, I will do exactly what I did in March and literally go all in. Last March, I went all in. 100% of my funds were going into silver. I wasn't buying any other asset class other than silver in that scenario. However, you need to have a look at what is the likelihood of that occurring. Or do we skip over that deflation, what they're saying, because central banks and governments just don't stop the printing, don't stop the intervention, don't stop. In fact, it converts to a form of UBI. So we have businesses that might go under, but the government will just come up with some program, here's cash, directly into households' pockets. I mean, that's one of the arguments for digital central bank digital currencies, is so that they can put dollars directly into households' pockets and just skipping the banking system and creating new loans, which creates new currency supply. So even the deflationists say that the end game is a stagflation environment. So I say, why not just prepare for that? If there is any pullback, buy. They're buying opportunities. But we don't want to make the mistake by not having any gold and silver, and the deflation never comes, and we go straight into stagflationary environment. Then we have just bitten ourselves in the backside.
So here's silver's line break historical chart. This is one of your favorites right now. So this shows us two possible targets for silver here.
I always trying to use different maybe techniques. Line break, a lot of people aren't familiar with it. It's kind of like a point and F chart, point and figure chart, where we only get new lines, so new candles that are called lines. We only get a new one when there's enough when the close in an uptrend, when the close of that month or that line is above the previous close, then you get a new candle. If you move sideways or you don't go below three candles, then you won't get a red candle going down. So on average, it condenses a lot of the time. So it removes and anything time related, noise related. So if the market needs more time to digest certain news, this gives you a clearer picture of where your support levels are, what just a pure price action is telling you. And right now we have a pretty much the same setup. Here was the huge paradigm shift when the silver refused to stop going lower back in 94, starting to transition. And when we had that bullish cross above the zero line, off it went. Then we had that measure move. Now we had another smaller paradigm shift, same type of contracting volume, diminishing weakness in the silver, starting to define the right hemisphere of the arc. Hidden MACD, hidden bullish divergence. When your indicator goes lower, then the price action refuses to go down lower. That means it's kind of like a springboard, and it creates a lot of momentum to explode upwards in the price action. And then they did the wire cross going upwards. So much details. This is for the target. So for my 233, it's I'm having fun. Also, I'm noticing that silver loves Fibonacci numbers. So 233 is a Fibonacci number, which it would be the same, pretty much the same percentage move that silver did from its last takeoff single all the way to those 2011-12 highs. So if we add that from when we were having the signal here from the MECD bullish cross, that should bring us about to silver 233. And if we repeat when we had that same signal back in the 70s and 73, that's about a 1,600% move. should bring us over exaggerated here a little bit, 1800. That should bring me to in 350, 370s, 377 silver target.
And what type? Sorry, Patrick. What type of let's say timeline could that take?
Well, that's the thing with line break. Line breaks, it removes time, so you don't know. You have to use the other technical analysis tools with pure price action with the time, because this, like I said, it only adds a new candle if you do a new close, a new high. So if silver goes sideways for a few months, I won't even get a new line. So this is just the price action structure is set up to support silver going up to 233 or 377. That's the takeaway you should take away from this chart, and that those bullish targets are activated because of the MACD confirming that the fuel to consume to go to those levels. But there's no time. There's no on this chart you can't deduce how much time it's going to take to get to those targets.
Perfect. Another let's say abstract way, but another interesting confirmation that we're headed a lot higher here.
Yes.
Houston, we have a problem. 85% of silver in London already held by the ETFs. Now, I'm not going to go through this article. I will put a link in the description below. But friends, please click on it, read it, because it'll explain exactly the shenanigans going on in the London Vaults and the bullion banks, and yeah, let me just say the garbage that is going on there. So the ETFs are in trouble. So keep it going, guys.
Kyle, can you talk a little bit about gold and why at UTIMCO? Why at UTIMCO you actually took delivery of the actual gold?
So I'll give you my opinion. I won't speak on behalf of UTIMCO.
Sure.
So my opinion is very simple. As a fiduciary, which I am in that position, to the extent that you own gold and you are going to own it for a long time, it's not a trade. It costs us about 90 basis points a year to roll it through financial futures contracts. And then we went and looked at the COMEX. So the COMEX at the time had about $80 billion of open interest between futures and futures options. And in the warehouse, they had 2.7 billion of deliverables. So 80 billion of open interest, 2.7 billion of deliverables. We're going to own it a long time. You're on the board. You're a fiduciary. What do? Like, that's an easy one. You go get it. All right. So you go take $1 billion of the 2.7 billion and let them worry about the rest. And when I talked to the head of deliveries for COMEX and IMEX, I said, well, what if like 4% of the people want delivery? And he says, oh, Kyle, that never happens. We rarely ever get a 1% delivery. So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold.
So this is a chart with obviously gold, not silver. However, when we have a look at the gold price and the US 5-year real yield, so that's real rates, not nominal rates, you can see that gold correlates very well with it. However, as the 5-year real yield has increased, gold hasn't. And this could be a chart that speaks about silver as well. And so we're expecting gold. We're expecting gold this year. Our price target on gold is around that $2,400-$2,500 an ounce later this year. So if gold goes up to that, then silver is going to go up a lot more. And that's just how it works. Now, I've mentioned in previous videos about the supply of silver. This chart just shows that the amount of investment into mining exploration is at record lows. It's never been lower. And Keith Neumeyer from First Majestic just recently said, as of yesterday, that they're currently mining 8-to-1. So for every 1 ounce of gold, they're mining 8 ounces of silver. And when you've got the gold-silver ratio around the high 60s, early 70s, that's just not real life. That's not real life. The real life in the ground real numbers between gold and silver is now 8-1. That's the mining. That's what's coming out. And so when this paper market is finally destroyed and got rid of, we're going to see the true value and the true price of both gold and silver. But silver has just got so much more upside than gold does. When you're looking at a mining ratio of 8-1, and the gold silver paper ratio is around that 70-1. Silver's just got so much upside to go, and that's why I'm so bullish on the metal, as well as the fundamentals of the electrification of the economy as we move to a green economy. Then there's going to be so much more demand. So demand for silver only goes up while supply continues to go down. So I still think that silver is one of the most undervalued asset classes in the world. And I'm still buying at these prices. Recently, I've been buying physical silver, but in a larger way, I've been investing in silver miners and especially in silver explorers. And I've got some very exciting silver explorers that have got huge deposits of silver. And as the underlying asset, that underlying price of silver goes up, then those explorers are going to be worth so much more. And so I see just a great asymmetrical play, huge upside with very low downside risk at all. So I'm still bullish on silver. I think silver's heading a lot higher. And if it does pull back a little bit, that is just a golden opportunity to buy more. That's my opinion, not financial advice. You guys do whatever you guys want to do, but I think this is a great play for me. So love to see your thoughts and opinions in the comments below. If you like this video, please hit the like button. Really, really appreciate it. And I'll see you again on another episode of Finance Uncut.